So as we get started tonight, this questionnaire, Patty Rasa brought it for us. So if you'd like to pick one up on the way out, I think it's a very helpful piece of paper. It talks about historical returns on your investments, gives you some questions to help you understand who you are at this moment in time, risk tolerance, all that kind of stuff. Just keep in mind that when you answer questions like these, it's based on how you feel at the time, right? So if you're in a good mood and you answer that and the markets are up, go ahead and answer the same questions when the markets are tanking and you're in not such a great mood, and see how much that can change, right? So just keep that in mind as you go through that process, that anytime you take those kind of questionnaires, remind yourself that they're capturing a moment in time. And so what I would say is take the questionnaire like 3 times. Take it when things are kind of calm. Take it when markets are zooming up and you just feel like Einstein. And then take it when markets are tanking and you feel like shit. And you feel like, what the hell, Finley's an idiot, right? So go through those 3 times and then maybe get an average of that, and maybe that's about where you're at. Okay? So tonight, we're talking about this recap, like pulling it all together. What we learned this semester, this is week 8, and of course, it's what can we take with us to go forward with what we've gained. Take a moment to read that. So sometimes it's this idea, people think, well, man, I'm gonna wait until I get it all figured out. Dude, you're never gonna have it all figured out, ever. I don't have it all figured out. The point is, as you learn, you do. So you'll hear me say this multiple times tonight. It's the person who takes this information and takes action with it. That's the person who changes their life. Not the person who learns and then comes back and learns some more and never quite gets off their ass to do it, right? So it's the action component that actually changes your life. And is that a little scary? Sure it is. But you got to do it. Because until you start taking actionable steps, your life isn't going to change that much, even if you're smarter. So before investing, some basics, right? Get rid of high interest rate debt. It's a no-brainer. You got a credit card paying, you're paying 12% interest rate or more. Well, put money toward that. It's a guaranteed rate of return. So never have high interest rate debt when you're trying to invest money, right? No-brainer. Always have money set aside for emergencies. Hopefully I'm telling you something you already know. You shouldn't be investing every dollar you got into the markets and then all of a sudden shit happens and you don't have any cash that you're going to need for some kind of emergency, a deductible, an insurance policy, whatever the case may be. And of course, become a great saver. We've talked about this. You can be the best investor in the world. You can have a portfolio return averaged over 20 years at 11% a year, which is awesome. After cost, if you average 11% a year after cost for 20 years in a row average, you are one of the best investors in the world, I promise you. And it's achievable, by the way. My average return over my lifetime is 11.9%. So I know it's achievable. But the question is, how much are you going to save? How much money are you going to save building that capital to grow it efficiently with your investment portfolio? It's key. Great investors can only really create more wealth as they become great savers. And of course, keep learning from those independent sources. Brought some more books tonight. You know I'm pushing books on you. I really want you to read. Some of you have started. Some of you are like, no, I'd rather just hear you talk, Finley, because it's easier a little bit, right? I get it. But, keep this in mind. I should not be your only source. I don't have all the answers. And many of the books I reference, they gave me the information. I'm here sharing it. And it's going to help you by finding the right people to cross-reference what you're learning and hearing about in here. It will make a difference as you really start connecting the dots. So those independent sources, right, the true experts on the subject, they're not salespeople. Most sources should be ignored, right? We talked about that. When I say most, I mean the vast majority of people out there, you should just tell them to take a hike. That would include family members, friends, associates, not because they may not care. So let's pick on mom. Mom may care a lot about you. She may not know jack about investing. So she may tell you things like, now you be careful, don't lose all your... Thanks, Mom. Mom doesn't know. That doesn't mean mom's a bad person. Doesn't mean mom doesn't care. But that doesn't mean that she's somebody that we should be learning from on this very important issue. Those are the experts, the real experts on the subject. And again, as always, I'll be happy to send this PowerPoint to you if you request it. So learning from the experts. And by the way, some of these people are easier to read than others. Some of these authors will connect with you. You know, whether that's Bogle or Ellis or Bernstein. So Bernstein tends to be my favorite. As I read and learn, he seemed to connect with me better than any of the others. Some of them connected well, some of them not as much so. By finding and reading the different authors, you might find that one author really connects with you and you seem to find some kind of connection with that person. So read by more authors and you'll start to find that one. Because there's more people to learn from. And again, I provide a list of 10 books tonight. You should read them. And I know some of you are like, dude, just Finley, just keep giving these classes, it'll be fine. Read them. If you do, you'll see your life change. I promise you, once you take action with what you're learning. So understanding human behavior, this is something that you have to really look in the mirror to learn about. Recency bias, this idea that what just happened, right? We think it's going to keep happening. It's a human behavior. It's a problem for every one of us. And just by identifying it, we say, okay, market's tanking, doesn't mean it's going to go down forever. I'm not going to lose any sleep over it. Or the market's zooming up. I'm not going to try to throw my money in it now because it's going to keep going. No, it's not going to do that either. It's going to revert back to its mean. It's average over time. And by the way, as we go through all the recap tonight, some of you, you're going to see all of it and you're thinking, I got it, check, 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 check. And some of you will be going, well, that simply means you might need more classes. Okay? So reversion to the mean, again, this idea that what goes up will come down, what goes down will come up. It reverts back to its historical average over time. And again, by understanding those historical averages, by understanding how markets have worked over time, we're better prepared for what might be coming in the future. Alpha, we start to realize that chasing alpha, chasing a return beyond the market is a fallacy. It's a mistake. It's a fool's errand. And some of that has to do with ego and overconfidence. You know, and once we realize that, okay, I don't need to beat the market, I just need to be the market. Once you get to that point, you're way ahead of so many people out there. And then loss aversion. You know, again, this idea that us making $10,000 doesn't feel nearly as good compared to us losing $10,000. We feel so much worse when that happens. There's something in us that just goes crazy when we see the value of our account go down more than when it went up, even though that amount may be the same amount. So again, acknowledge that. Say, okay, that's who I am. I'm human. I have to learn to overcome that. And I shouldn't be reacting in some negative way just because my emotions are starting to flare up. If they flare up, go for a walk. Go find a good therapist. Doesn't mean do anything with your portfolio. So ignore the media. Almost everything you hear from the media is crap. I think most of you probably know that by now. Sensationalism, it's getting you to watch the television so people can sell advertising, get you to hit on a link on the internet so they can sell advertising. The more sensational it is, the better the advertising bucks will be. It really is that simple. So they're not an expert just because they're on television. Having opinions doesn't make them right. Sensationalism sells. That's what the truth is. So by knowing that, you realize, okay, that's not where I go to learn about this very important issue. Avoiding individual stocks and bonds, it's a fool's errand. It's this idea that somehow I know the right individual stock to own. I think Tesla's going to be amazing. No, you don't. No, you don't. Because every time you buy, or every time you sell, the other person on the other side of that trade is almost always a professional or a computer who know a lot more information on the subject and that particular stock than you do. So once you come to that realization, it's like, why would I do that? Because that other person on the side of the trade, that could be Warren Buffett. Which one of you think you're going to outsmart Warren Buffett? Yeah, well, you're not. You're not, and neither am I. So we don't want to trade with professionals. We don't want to trade with computers that have algorithms built just to capture a moment in time when they need to sell or buy. What we want to do is we just want to let that price be affected naturally. Let the market go ahead and capture all the information, and you and I simply own the market. Because owning and buying individual stocks, you're the last person to actually know the information. It's like being invited to a party. It's a great party, and they told you to come at 9, and nobody told you the party started at 6. And when you show up at 9, most of the people are gone, you got scraps left, and they're not very good scraps. That's what investing in individual stocks is like. So broad diversification, there's the key. Broad diversification, owning markets all over the world, stocks, bonds, that will reduce the risk. Because, you know, one of the dirty little secrets when it comes to this issue of investing, it's not just about trying to make decent money on your investments. It's also about not losing a huge chunk of money because you didn't diversify, because you took way too much risk. That's why you avoid individual stocks. Avoid life insurance. This is like the worst way to invest your money. I don't know if there's many worse other than investing with crooks like Bernie Madoff, right? Otherwise, this is the legal version, I would tell you, of Bernie Madoff. We're talking about annuities, talking about whole life. So high fees, 2.5%, 3% a year in fees. And if those fees are coming out of your account, which they are, well, who's paying them? It's not the insurance company. It's not the insurance agent. It's you, the client. So once we realize that, okay, that's not the way to do it. And again, if you spend a lot of time around a life insurance agent, he's very good at glossing everything over, making you feel like this is awesome. This is crap. And once you identify the independent experts and learn from them, well, of course, you'll know that. Just see through the promise guarantees, because they're really just promises that are not really going to be kept for a long, long time. At the end of the day, you're trying to fund your retirement, not that guy's, because you can't afford to. You got to focus on funding yours. It's hard enough just to fund yours. Avoid managed mutual funds. This is a little harder. It's this idea that a managed fund, you would think, would beat an index fund. So a managed fund, right? A man, a woman, a committee, they're managing, buying stocks, avoiding other stocks and bonds. They're picking winners and avoiding the losers. One would think that's the way to invest. That's how I got started. You know, you chase after 5-star funds, managed funds that did well in the past. It's a terrible way to invest money. It's called chasing performance. And what happens here, managed funds are run by smart people, but they're trading with other smart people. And they're trying to compete on this big platform called Wall Street, and that costs a lot of money. And all those fees make managed funds a very poor way to invest your money. And again, we know this. We've known this for over 3 decades. So this is also about educating yourself so you know what really smart, educated investors have done to be successful and what the ones that have not been so successful have done. Play the probabilities over possibilities, right? And what we know is the probability is the index fund is going to far surpass managed funds. We know this. We know this. And again, it's that casino idea. And we've talked about this. Do you want to be the casino or the gambler? Now, if you want to be the gambler, you can. You can walk down to the casino and you could hit it big. It's possible. Is it probable? Hell no. No. But what is probable is the numbers are in the casino's favor. And over time, they're going to win. Index fund investing is the casino. Be the casino. Buy those index funds. And just buy them at a low, low cost. And then stay passive. Make sure that you're buying the lowest cost index funds that you can as you diversify all over the world. Index funds, a fund that tracks an entire market like the total stock market in the United States. You're not trying to pick the winners and avoid the losers because you don't know who they're going to be. So you just own them all. The good, the bad, the ugly. And we listen to this guy. And I know you've seen this quote, probably. You could almost probably recite it as many times as I've probably shown this to you. But again, it's a reminder to all of us. Who are you getting your advice from? And if somebody is telling you something very different than this guy, who are you going to listen to? The greatest investor of her time or Uncle Joe? Or mom? Or some local yokel financial advisor or insurance agent? It's a ridiculous thought, and yet many people ignore his advice while taking amateurs' advice. Listen to that guy. Again, it's all cost. When we look at $20,000 earning 8% a year with $50,000, what happens when we're paying 3%, which is basically a load managed fund, could be insurance products, 1.25%, no loads, but a high cost managed fund, 0.5% low cost managed fund, or maybe 0.04, which happens to be the cost of the Vanguard Total Stock Market Index Fund. Well, that $20,000 after 50 years, and keep this in mind, and I come across people like, oh, I'm doing well, right? They'll show me a number like that. Well, how do you know what well is? You know, in other words, they're not comparing that to anything other than they've got $204,000 after 50 years, and they think they've done well because they started with $20,000. They're not comparing to that or that or that. They're not making those comparisons. Because then all of a sudden when they do, it's like, well, that sucks. I could have had that. There's the truth. And so, and I promise, if you haven't, you will. You're going to run up against people who say, oh, no, I'm good. They don't know what good is. And they're not apparently willing to go down this path of a real education so they can see what their future returns could be. So buy income-producing assets, right? If it doesn't produce income, avoid it. It's one of the simplest rules of investing. Stocks, bonds, real estate. It's easy. Buy those. Just keep an eye on cost. Anything you're buying when it comes to investments, you want to buy at the lowest possible cost. It's not that hard. No-load index mutual funds were created by a guy by the name of John Bogle, 1975, for us, for the individual investor, to do what was best for us instead of what's best for the industry. And over time, that simple invention has changed millions of lives for the better. People like us benefit today based on what John Bogle did in 1975. We should stand here and thank God John Bogle did that. Because without that, the whole industry would be very different. Be a lot more expensive for you and I to invest. We'll be trying to figure out how to make more money because all the costs would still be all over the place. No load index funds, right? You purchase the lowest possible cost, so you've eliminated the middleman. There's nobody between you and the investments. Keep it as simple as possible. If you want to own investments outside of retirement accounts and normal brokerage, you want to make them as tax efficient as you can. Basically, so you keep money in your pocket instead of somebody else's. That's it. You squeeze out the costs so they're lower and the returns are higher. Allocate and own the world, right? Right asset allocation, how much you want to have in stocks and bonds and real estate and cash. Basically, use modern portfolio theory. You pull different asset classes together into one big mix, so together they make for a good portfolio. Something that's moderately risky that's going to give you a decent return over time. Now, some people would say, I don't want any risk. Well, then you're not getting any return, right? That's how it works. You want to put your money in the bank and earn 0.1 or 0.2, you go right ahead, but inflation's going to eat that money up forever. So risk and return, they're together. We have to take risk to get a decent return on our money. We just want to take the right kinds of risks. That efficient market hypothesis simply means that the market reflects what's known and plenty of what's not known, i.e. people who cheat. So the market together is trading at a moment's notice on every bit of available information. And so by the time we hear it, well, we're late to the game. We're late to that party. So by acknowledging this, we say, okay, the market knows more than I do. So I'm not trying to outsmart the market. I just am trying to be the market. Because the market is made up of a lot of smart people with a lot of information. All those smart people running mutual funds, they're the market. All those computers, they're the market. Warren Buffett, he's the market. All those people work for you when you own the market. And then you rebalance on occasion, right? So whenever you've identified your asset allocation, myself example, 80-20, 80% stocks, 20% bonds and cash. If I happen to hit 90% stocks, I'll go back and rebalance, sell stocks to get back to an 80-20 mix of stocks and bonds and cash. It doesn't have to be complicated. And you think, well, how often do I have to do that? Well, when my band hits 10%, that's for me. And how often does it happen? Maybe twice a decade. Otherwise, I go in and look on occasion, and then I go back to live my life. That's how simple this can be once you put together a portfolio properly. That's Stu, right? Reminder, you're pulling different asset classes together to make for just the right mix. Some of those asset classes are risky. Emerging markets, for example, they're risky. But you pull them in there with some total bonds that are high quality in the U.S., total stock, maybe some real estate. Together, it makes for a very nice mix, a very nice portfolio, where when something's going down, something else is going up. So asset allocation number one, it does give us a glimpse into the future. You've heard me say this before. You show me your asset allocation, you show me your cost, I'll tell you what the next 20 years are probably going to look like for you. Now, can I see the future? Hell no. But I know what the past 20 years did. I know what those allocations did. I know how big of an impact cost has. It's not that hard. Once you figure out all the past by studying it to see what the future might hold, it gives us a glimpse into the future. You're just trying to figure out how much you want to have in stocks because it's a big deal. What I found is the more educated you are on this issue, the more that you realize that there's all kinds of risk involved when it comes to investing money, you tend to have more money in stocks. You tend to increase that allocation because you realize The risk, the market risk of stocks is simply one risk you have to concern yourself with. There are many risks. And so through that process, you end up with a little more stock exposure, maybe US and international, because you have high quality bonds, you have real estate, you have things that are going up when on occasion those stocks are tanking. But at the end of the day, you got to figure out what's right for you, right? I can't tell you what's right for you. Nobody can. You got to figure it out for yourself. Sometimes I work with people and they look at me like, okay, Finley, just tell me. I can't do that. I'm going to try to help you. I can try to help you figure out what the right allocation is for you. You got to live with it. You got to sleep at night. If you're in a 80-20 allocation, 80% stocks, 20% bonds, cash, and I sleep well with that, you might be restless. You might be scared to death. You might watch too much television. Well, then maybe 80-20 isn't right for you, or you need to become more educated on the topic so it becomes more right. And turn off that television. At the end of the day, you got to be patient. John Bogle gave some of the best advice. When in doubt, just stand there. When in doubt, just stand there. Put together the proper portfolio, allocate it appropriately, diversify it as much as you can at the lowest possible cost, and then when in doubt, stand there and do nothing. And that can be hard because I'm the guy who says, you got to get out there and take action. Well, that's to put the portfolio together. Once you've done that, then don't be taking action. Do nothing except maybe rebalance on occasion. Start small and expand. So a good place to always start when you're first investing money, total stock market index fund, something that owns the entire U.S. economy. Good place to start. As you add to that, you add a bond index, a high-quality bond index that owns corporate bonds, government bonds, high quality, no junk, no high-yield bonds. High-yield bonds equals junk bonds. So that bond index is going to tend to go up when U.S. stocks are going down. And then we add an international stock index. We add another stock index that can go up and down at different times in relation to the U.S. stock index. So those two stock indexes helps you to own the world in stocks. You own all the public traded companies in the world. And you get to capture the returns based on how all those companies do. And here's the wonderful little thing about index funds. You own an index, and there's some company in there that, you know, is doing a piss poor job. And they're starting to go bankrupt. Let me think of a name here. Tesla. Tesla's having a lot of problems. They're very close to going bankrupt. Well, they're in the index. So you think, oh, shit, where should I? Well, don't worry about it. If Tesla keeps doing poor, they will drop out. And they'll be replaced with another company that's doing well. So your index is there to kick out the losers who don't seem to know how to run businesses profitably, and they capture the companies that do. You get that simply by owning the index. Also consider adding 10% allocations to a couple other allocations. We've talked about this, specifically real estate. So commercial real estate, stock and commercial real estate, adding a 10% allocation to the stock portfolio has historically provided a little more return with a little less risk. That's awesome. I'll say that again. A little more return with a little less risk because of that negative correlation. It's going up or down in relation to other stock index funds. Do you have to own a real estate index? No, you don't. But it's worth considering. I do. Consider adding, because if I'm in French, a small cap value index fund. So small cap, small companies, value oriented. Value meaning companies that the market tends to not like as much. Because they don't like it as much, they don't talk about them as much, they don't trade them as much, and historically, they do much better. Historically, that kind of fund has averaged about 15% a year, while the stock market, the U.S. stock market, has averaged about 10% a year. Now, does that happen every year? No. It fluctuates just like the stock market does. But it has a lot to do not just with taking a little more risk, because small companies are a little riskier than big companies, but it's also behavioral finance. It's this idea that traders, Wall Street, individual investors, they get so excited about the high-flying companies, Uber, Lyft, Tesla, whatever else is coming around the corner. They end up overanalyzing, overtrading, and they underperform. This is the opposite of that. So again, consider adding 10% to the stock portfolio small cap value index, as well as the real estate index. Again, do you have to? No, you don't, but I do. Defer tax in retirement accounts. It's no brainer. For most people, you're wise to put money in retirement accounts whenever you can. Again, my rule of thumb, look at $60,000 as an individual, maybe $120,000 roughly as a couple. So if you're making under $60,000 in a given year, gross income, you'd consider Roth. If you're making over $60,000 a year, single individual, you would consider pre-tax. In other words, you're trying to figure out what your future tax rates are going to be, and that's pretty much impossible, but you're estimating based on your current tax rates. So if you're making less than $60,000 a year now, you're not paying that much in federal income tax. Now, you might think you are, but in relation to what you could be in the future, not so much. So consider these issues as you're putting money in retirement accounts. And always consider a Roth IRA. Roth IRA money goes in after tax. All the earnings after 5 years will be tax-free that you can use for anything you want in your future needs. Inflation's your enemy. Inflation is that quiet monster who will eat up your money. Something Mom should have warned us about. That monster is really the one you got to worry about. I would tell you personally, that is a much bigger monster than the market. The market volatility going up and down, it will always go up and down. That inflation monster, it just sits there day after day eating up your money. And if you're not earning a return beyond the inflation rate, your money is losing value as we speak. So overcoming that inflation rate is critically important. Money sitting in the bank is shrinking as we speak. People who think, oh, it's safe. No, it's not safe from inflation. Just because the number doesn't go down, the value of it is going down, and by a lot in some cases. So at the end of the day, stocks have crushed inflation. Historically, a 7% return beyond the inflation rate. A 7% real return. The nominal return, 10% minus the inflation rate, roughly 3%, 7% real return. You want a positive real return after inflation if you want your money to grow over time. And again, U.S. stocks, international stocks, they've done that. And they'll continue to do it over time, almost guaranteed. Can anybody guarantee? No, nobody can guarantee the future. But I can tell you this, that is playing the casino. The odds are so much greater there than they are in other places. Play the odds, be the casino. Consider Vanguard, right? You pay no loads whatsoever, because you don't have any salespeople. You got to go straight to Vanguard to invest in the markets. You'll pay ultra low fees, right? You have many options. You don't need that many options, just enough index options to invest and diversify. And you can transfer funds there. You move money from some crappy place with high fees to Vanguard and low fees. Whoa. So there's a list of Vanguard stock index funds. Good list. You can own some or all of them. Most importantly, you have a plan. And you have an idea why you want to own this fund and this amount of money and where, i.e., is it in a Roth IRA, is it in a 401k, is it in a brokerage account outside of retirement? Have a plan. Have a plan. And of course, list bond index funds and a money market paying 2.45% for your cash. So, what, this money market? Oh yeah. Oh yeah. There's nothing here that doesn't exist that I'm talking about. I promise you. All right. Now, the reason why some people maybe don't know about some of this, right? Why is that? Well, because this is benefiting you as an individual. It's not benefiting a big part of the industry. The bank, it's not like you're going to go down to your local credit union or bank and say, hey, do you know Vanguard's paying 2.45? No, of course I'm not going to tell you that. They're going to say, give us your money. We're going to pay you 0.2. We're going to loan the money out at 6%, and everybody's going to be happy. Well, maybe not so much you. So your education will identify better places where your money can be working for you instead of someone else. Yes, sir. So you can go online, 2 business days, you move that money to your bank account. You can call them up on the phone, same thing, 2 business days, money in your bank account, or you can write checks off that account for $250 or more, much as you want. So the money's liquid, it's accessible, but it's actually earning something. And there's no hoops to play. And I know some of you know what I'm talking about. Credit union, bank, they say, well, if you use the ATM this many times, you make this many deposits, blah, 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 then we'll pay you a certain rate. And that's fine. If you want to play that game, go ahead. I'm not willing to play all those games.
I think some credit unions are insured, FDIC or what's the insurance for the money market at Vanguard?
It's never lost. That's the insurance. And so think of FDIC insurance as a guaranteed loss. That's what it is. When you have extra insurance, you have lower returns. It's exactly what it is. So this fund has never not paid out in the history of that fund being alive. $3,000 minimum. If you don't have that amount, you can put money in a settlement fund at Vanguard, which is a federal money market, and that's paying about 2.3% a year. And you can put $100 in there. As you build that up to $3,000, then you could buy the prime money market. Again, that's where I keep my emergency cash. That's where I'd recommend keeping yours, unless you can find a place paying higher rates of interest. And by the way, that's going to track the Fed. Fed drops rates, that number is going to come down. Fed raises rates, going to go right back up. Yep. Yep. 2 days. Yep. So buy real estate with great care, great care. So buy a personal home to live in. Don't buy a personal home as an investment. It's not a good investment. It's a bad investment once you consider all the costs that come with a personal home. So don't listen to the real estate industry tell you how great of an investment. It's not. It's a bad investment. It may be a great place to live, but again, when you look at something to invest in, you're looking at a positive, real return on your money. That's not going to happen in a personal home at all. Not even close. You'd be lucky to lose only 5% a year as you consider all the costs that you incur in a personal home. So you buy a home to live in, raise a family. You don't buy it as an investment. Leverage is not always your friend. Don't let people convince you that you can make all this money with real estate as a personal home. The chance of that happening is very low. What's more likely is you're going to hit the inflation rate with your return on the home minus about 10% a year in cost. Rental property. Now, rental property can make money, no doubt about it. Somebody who knows how to buy rental property at a good price, manage it themselves, take care of it themselves, making sure the cost is pretty low, they can make money over time through appreciation and rent. And for some people, that can work. For other people, not so much. I would be not so much. My advice, for most people, you're better off with publicly traded real estate. Commercial properties that basically are stock companies that own dozens and dozens of commercial properties in large cities like Minneapolis, Chicago, whatever, costing you 0.12% at Vanguard with no headaches and nobody not paying. and no toilets broken. Be tax efficient. So when you're going through the process of investing your money, be as tax efficient as you possibly can outside of retirement. So when you're looking at outside of retirement, stock index funds are very tax efficient. Their turnover rate is very low. Turnover rate, how much buying and selling is happening within the mutual fund. So the total stock index at Vanguard, total international stock index, about 4% turnover. You want a single-digit turnover rate when you're investing outside of retirement accounts. That will not happen with managed mutual funds because the managers are buying and selling often, and that's causing you to pay more short-term capital gains. You want to pay long-term capital gains. Broad market index funds, total stock, total international stock. Those low turnover index funds, you will save in taxes because you'll end up with long-term capital gains, and the long-term capital gain rate at worst for most people is 15%, and for a whole lot of people in the 12 or 10% tax bracket is, anybody? 0. I like 0. Harness the emotions, right? Knowledge, understanding that we are human, we have emotions, finding ways to manage the fear, manage the overconfidence, being self-aware. Like, okay, that's how I'm feeling. I need to deal with that. Push that greed gene away. You know, every time you start to feel greedy, you got to remind yourself, greedy people, they don't do well with investing. They get slaughtered many, many times. Understand bubbles. Talked about bubbles. We talked about herd behavior, getting caught up in what everybody else is doing. The wise investor is willing to go a different direction. If the herd is going one direction and you know that emotions are driving them, you know that you can go a different direction. Now, in the short term, you may look like you don't know what you're doing. In the long term, you'll come out ahead. Gyrations of markets, right? They go up and down. We have to accept that reality. That's risk, no return. That daily craziness should be ignored. Just ignore it. Now, some of you, it's okay to be honest, some of you look at the markets every day. And that's okay as long as it doesn't bother you. Others of you, you don't. Because you know if you did, wouldn't work out very well. Your emotions would maybe cause some problems. So you don't. And you don't have to look. You don't. So in the old days, some of you know this, right? You got a quarterly statement, piece of paper, told you what you earned or didn't earn, and then you filed it and you waited for the next quarter. Well, of course, in today's world, you can go online, you got an app right there. Oh, market's doing this, right? So we want to be careful not to let all that noise affect our emotions. Keep them in check. As I said, become a robot. Of course, we're not robots, but that mentality of not letting our emotions drive our decision making. Once we can get through all that, we will be a much better investor. Because buy and hold works. It's worked for decades, and it's still going to work. And it's real simple. Nobody knows when to get in, when to get out of the markets. And if you think you do, remind yourself, you got to be right twice. You got to know when to get out and when to get back in. It's a fallacy to think that you can do that. And there are people all the time who think they can. Well, that's ego. That's overconfidence. That's emotion that is hurting those people's return over time. Not just in returns, but also in taxes. The wise investor buys and holds. Avoid the crooks. We talked about Madoff. We talked about Enron. We talked about the red flag of people saying, hey, I guarantee you 10% return. Anybody who wants to guarantee you a 10% return is either a crook or they're delusional. Either way, you want to get the hell out of there as fast as you can. So you want to be skeptical of the next big thing. And there's always a next big thing. You know, not too long ago, it was Tesla. Well, they're getting close to bankruptcy. That was the next big thing. There'll be something else. Once upon a time, Apple, right? And, you know, people think, well, Apple's doing great. Well, Apple was like that close from bankruptcy before Jobs came back, right? So we forget these things. There isn't any company that cannot go bankrupt. No company doesn't have that possibility. So by avoiding individual companies and thinking somehow we know the great big thing coming, we should own everything, and we're going to get that great big thing. We're going to get one of them. We don't know which one. And also be careful of that great man mindset. I'm going to follow this great man, this person. It could be a woman. They know the future of markets. Because maybe they predicted something one time. Well, what happens is they might have been right once. Doesn't mean they're going to be right the next time. And just because they were right, i.e., they predicted the market going down, well, nobody maybe realized that they were talking about that for 5 years before it went down. So, you know, somebody's always going to try to be the next Warren Buffett or whatever it is. Don't look for that person. That person may come up somewhere later down the road. We don't know who that's going to be. Don't put all your money on the bet that you're going to know what that one person is or who it's going to be. Avoid those fee-based financial advisors. Smoke and mirrors, just salespeople trying to convince you to give them your money so they'll make you more money, and that's not what they're going to do. Don't be swayed by the credentials. They try to impress you. They look sharp. They have all the nice words. They're just not. They're not the experts. Select a fee-only advisor if you need one. So a fee-based advisor is a glorified salesperson. Their job is to pull in money as much as they can to make money off of you, not for you. A fee-only advisor, a good one, is there to help you as you need help, maybe to transfer money over, to get a financial plan, to put a portfolio together, to get you going in the right direction, where you pay them and only you pay them. So those fee-only advisors, you're the one paying them. They're not getting paid behind the scenes. They're not selling something. They're not pushing a product because they're getting paid to push that product. They may charge by the hour, they may charge by the project, may charge under money under management. In other words, you identify what they charge. If you're looking for help, you sit down with one and you say, okay, what do you charge? Let's get an idea. And if somebody can't clearly tell you how they charge, well, get the hell out of there. You don't need them. You don't need them at all. If somebody isn't transparent with how they make their money, you don't want them helping you with your money. It's that simple. So, question is, do you need investment policy? Do you need to put together an asset allocation and a rebalancing project so you can basically get your portfolio together? Or do you need more extensive financial planning? Social Security strategies, insurance strategies, tax strategies. You know, what kind of help does a person need? So a person would want to look at that if they're looking for help from a fee-only financial planner as you interview them, i.e. you interview them. They're not interviewing you. You're trying to figure out, is this somebody I trust? Is this somebody who is educated and knowledgeable on the subject? And do they charge a reasonable fee? Because at the end of the day, sometimes they can help you because you may hurt yourself. And when I'm talking about is emotions. Some people are emotional basket cases. They just are. They let their emotions cause all kinds of problems. And whether you're that person or you have a friend who's that person, they probably need some help. Because otherwise, they're going to make bad emotional decision after bad emotional decision going forward. So local advisors, Mike Dunlop, Mike manages money for people. So for people who really need help managing their money, He'll do it for them. Casey Redmond will help you put together a portfolio. He'll help you get that asset allocation right. He'll help you transfer money, and then he's going to leave you alone so you can manage it yourself. Patty's here tonight. Patty will sit down with you. Patty, all these three will give you a free visit. You can talk and see if you're the right fit. Patty charges $50 an hour, so it's about as reasonable a fee as you're going to get as you look for help and advice in getting everything put together. And again, it's not like I wouldn't put these people up here if I didn't trust them, right? Those three will help you if you need help or if you have loved ones who need help. But as a reminder, I'm the guy who says you can do it yourself. That's what this class is about. And I want you to learn how to do it yourself. But if you really feel like you need help, then these are the kind of people that can do it for you. Axel works at John Deere. He's an engineer out there. He's educated very well on the John Deere plan, pension, 401k, all those benefits. And he'd be a very good contact, a fee-only advisor for people who work out at John Deere. By the way, those cards are up here if you want to pick up some of their cards at the class. Some final thoughts. Continue to gather the knowledge, right? Keep building on what you're learning. Some of you, this is the first time you've been in this class. How many people have been here more than once? Look at all those hands, right? And it's about adding to what you know, right? And I know some of you who've been here the first time, you think, well, why would I keep coming back? Because you're going to learn more. What happens is information's new, and it's like, oh, shit. And the second time you hear it, it starts connecting better. There's information in your brain. It's like, oh, yeah, oh, I didn't catch that. Oh, I didn't catch that first time. And it starts connecting. You're adding to your toolbox is what's happening. And so through this process, you gather the information as you build on what you've learned previously. Just don't wait till you have it all figured out, right? You got to take action, folks. You learn enough, you take a step going forward, you do what you need to do, transfer, you start putting things together, and you keep learning as you go. But don't wait until you have it all figured out before you do anything. It could be years and decades before that happens. At the end of the day, it's action. Action is what changes people's lives, not education. Education is wonderful. I'm a huge fan of education. Gathering the knowledge, it's incredibly important, but it doesn't mean jack if we don't do something with it. So take that action. At the end of the day, patience, right? So you've done it. You've taken the action. You've moved your money. How many people have done that? Look at all those hands. Look at those hands, right? So it's doable, and these are normal people. They're like you. You can do that from whatever age you are. You're not too young. You're not too old. But you got to take the steps necessary to put you and your loved ones in a better place. Because you can not only take this information and help yourself, you can help your loved ones. But once you've done that, then you just have to be patient. Because, here's a dirty little secret. Maybe some of you have experienced this. You do everything I'm telling you to do. You transfer it over. It's all allocated appropriately, low cost. It's like, yes! And then the markets go down. Like, shit! What the hell? Well, yeah, that can happen. There's no guarantee about what markets are going to do from day to day to day. You got to be patient through the process. It's irrelevant what markets do today, tomorrow, this week, this month. You got to be patient, and over time, markets have provided very good returns to the investor who buys and holds. They're patient through the process, just as John Bogle said. When in doubt, stand there. And listen to that guy. So at the end of the day, you know, we get the opportunity to change. We get the opportunity to take everything we've learned from the past, pull it together, and add to it. And some of you have made poor investment decisions. How many people have made poor investment decisions? I'm in there, okay? I'm in there as well, right? You can beat yourself up. I recommend you don't do that. I recommend you acknowledge the mistakes you've made, because most of the time it was legal. Nobody was actually ripping you off criminally. Might be ripping you off in other ways. But it was legal. But the reason they took advantage of you and me was because we didn't know any better. Our lack of education caused us to be taken and ended up losing more money because of that. Okay, you learn from that. You say, okay, not going to do that again. No. And you take what you learn and you improve as you go forward. Not only with your life, but again, with the people around you. Whoa. Some recommended books. Again, some of these are up here tonight. Read these books. Read them. Consume them, and then read them again. I promise you. So some of these books I read every year. So example, little book, Common Sense Investing, I probably read that like 30 times. All About Asset Allocation, 30 times. Investment Manifesto, 30 times. Now, why would I read them that many times? The book doesn't change. I've changed. And as I change, I'm adding something new. As I read that book, things connect better in my brain, and they'll do the same for you. So start. You might be surprised just how much information you can fit inside that brain. And then these next 5, right? So that first 5, kind of beginners. The second 5, not so much beginners. You keep adding. So now your level of education has risen, and you start reading more advanced books on this issue, and they make more sense because you built this foundation of investment education. So, as a reminder, next Wednesday, I'll be giving a tutorial on the Vanguard website. So, if you're interested in that, it'll be at Upper Iowa University, free of charge, and it's a computer lab. So you can sign in to your Vanguard account if you have one. You don't have to have one. You can bring a laptop and sign into your account, free Wi-Fi there. And I'm going to go through the Vanguard website using someone's password and showing you how to work the whole site, giving you all the details about how that website works and how you can make sense of all of the information on it. Again, it's next Wednesday, Upper Iowa University on University Avenue, starting at 6. Yes, sir. 6 to 7:30, 1.5 hours. Yep. I did that in April, and I'll warn you, it was packed. So I might recommend being a little early, because I'm betting somebody's going to be standing. And I wouldn't want that to be you. But it only holds maybe 40-some people. Okay? Any questions on that? Again, it's a way to understand the Vanguard website and what it can do for you. Okay, so this class will be repeated in the fall, starting September 5th, running through October 24th, in the UNI Library Scholar Space room, which is in the 2nd floor. So if you're interested in taking this class again in full, the whole 8 weeks, there it is. And again, you think, well, do I need to take it again? Well, if you talk to some of the people who've taken this more than once, I think they would tell you, you will learn more that 2nd, 3rd time around. You really start to capture the information until, and I had this with a fellow once, you reach this moment where it's like, aha! He got it. He screamed it almost in class. Something connected in his brain that said, okay, I got what you were just saying there, Finley. It was kind of cloudy, and all of a sudden the sun started to shine. Questions on that? Oh, I'm sorry, I didn't mention that. So this class, I have an online financial happiness academy where cost you $70, and you can basically attend this class for a year, for 1 year. The video is on the class, so you can watch the class. You see my notes about the class for the 8 weeks, and you can attend it at your home, anywhere you want. Costs you $70, and if you put some numbers to it, is $70 worth thousands? You're damn straight it is. So consider it. That's the website that you can go to look at it and consider signing up. Yep, so retirement class is there as well as the investment class, and then the money management class will be probably on there early in the fall. Yep.
You had mentioned previously, perhaps monthly or every other month get together to discuss.
Yeah. You know, that's not bad. So some of you are familiar with bogleheads. So bogleheads are basically people who are, you know, big believers in John Bogle and his approach to investing, which is a lot of what I teach. And we meet twice a year on that. And if you're looking to be part of the Boglehead Conference, we meet generally once here, maybe once in Iowa City or Cedar Rapids. I am open to the idea of meeting once a month. I don't know. How many of you would be interested in that? Yeah. So it's the idea that you would meet and discuss whatever for an hour. And it's kind of like a club, you might say. It's a club of knowledgeable investors. That's what the Bogleheads are. People who actually understand this shit. Right? Versus is like, well, I don't know, dude. Whatever. Right? It's an opportunity to spend time around people who are knowledgeable, who can help you through some challenging questions or times you may have. So right now we don't have anything scheduled. I am open to that, and I'm going to put more thought to it. I like the idea. Yes, sir.
I've always been ahead of the curve with regard to being, you know, with computers and such. I've got kind of a paranoia so far as my, you know, whether my logging into my brokerage account is exposing me to some sort of vulnerability. Can you address that?
Yep. You have a right to be concerned. I get that. What I would say is that Vanguard does the best they can to protect your identity. They have over $5 trillion under management, $5 trillion. So they take it seriously. You can do most of your transactions, if not all of them, through the mail. You don't have to do this through the internet. You can do a great deal of information over the phone. So while the computer can be handy and convenient for many of us, it is not a requirement to investing with Vanguard. That's what I would say. Okay, so this is really the time for questions. Anything that I haven't talked about that you'd like to talk about? Anything that you would like clarification on that maybe I went too fast on, or you're still trying to kind of fully understand it? Anything's fair game. Yes, ma'am. Yep. So Fama and French are two researchers, 1992, they filed a paper, and what they identified was that the returns of markets, stock markets, have been captured from owning the market and owning more small companies and more value companies. And so what they've identified through research, not through opinion, is that if you overweight, own more small, more value, you've been able to capture more return over time. Now, in any given time period, that may not happen. But over decades, that's happened consistently. So for example, let's say somebody owned just the market and they were earning 10% a year. Nothing wrong with that, first of all. Nothing wrong at all. But if you overweighted to small cap value over a 3-decade period, you might have averaged 13 or 14% over that time period instead of 10. And I say overweighted, having more of. So the total stock market index fund owns small cap funds. It owns growth funds and value funds. So by owning small cap value extra, you're owning more of it. And so it's a research-based way of investing money. And it's worked in the past. Is there a guarantee that's going to work in the future? No, no. So, but let's look at some of the reasons why it works. One, you're owning more small companies. So that means you're taking a little extra risk. So you should be compensated with a little extra return over time. And then the value component is that behavioral finance issue I spoke of. They underanalyze, they undertrade, and they outperform over time because Wall Street and all the voices out there, they're so consumed with the high-flying growth companies, the Teslas and the Ubers and Lyfts and whatever great IPOs coming out. They're not talking about, man, that waste management is just so awesome. They're not. That help? Do you have another question? Okay, so let's talk about inflation protected, treasury inflation. So what you're getting there is a bond fund that's even lower risk because it's going to capture any unexpected inflation. So a bond fund normally has an expected inflation return in there. It's already has a certain rate expected. If inflation zooms up, your TIPS, Treasury Inflation Protected Funds, will actually give you more. They'll add return to that. So you might think, well, that's great, and it can be. But if inflation is less, well, you took less risk and you're going to get less return. So that is something for some people, if they want to, in their own mind, I want to make sure I at least stay up with the inflation rate. Owning TIPS inside a retirement account could be productive. So that's TIPS. Tax exempt, if you're in the high tax brackets. 22% on the low end, 24, 32 on the higher ends. Holding that outside of retirement. So you want to hold some money outside of retirement, you're paying a boatload of tax. The tax exempt fund could help you because you're not going to pay any federal income tax on that, state of Iowa. You will pay state income tax, but no federal, and that's going to work better for you because you're in a high tax bracket currently. That's the purpose of that fund. Other questions? Yes, ma'am. Okay, so bonds pay interest every month. Money markets pay interest every month. Your stocks pay dividends every quarter. So they're going to, in most cases, what you want to do is have them reinvested. So when they pay you, they reinvest right back into the fund. So you're buying more shares, compounding over time. And then in the year, you will receive some capital gains within that fund. So at the end of the year, you'll get a little bigger bump. And that is all your income for the year. And then the earnings on that mutual fund is the market going up or down over time. You'll pay tax if it's in a non-retirement account. Yep, on all the dividends and interest that is incurred during the year and short-term capital gains. The good news is total stock, total international stock, you'll pay a minimal amount of tax in a given year. Yes, sir.
As this class what I'm getting at is there's a sort of a spend down rule with regard to Medicare and that sort of thing. To recommend that people get with somebody with regard to establishing a trust so that one does not spend down one as well.
Yep, so those are things I talk about in my retirement class. So consider that. It's an 8-week class. Talk about strategies on how to spend down your money in a wise, tax-efficient way. So you still have money by the end of life, but you're trying to reduce your taxes along the way, whether that's through estate planning, whether that's through using IRA money, let's say in your 60s, as you delay Social Security. Could be converting some IRA money to Roth money as you're trying to reduce your RMD that could affect the way your Social Security benefits taxed. So there are many strategies. You're wise to be thinking about that. I talk about them in my book, Graduation. I would encourage you to attend the retirement class because I do talk about that quite a bit. Retirement class is going to be here in the fall, starting on September 4th, I believe. September 4th, right here, is the retirement class. Yep. And by the way, all of these classes are now currently updated on my website at thecrazymaninthePinkWig.com. Right, my card's up here. You can see all these classes and what class is designated to teach on that given night. Okay, all on the homepage. Okay, yes, sir.
You mentioned the Vanguard stock index funds. Are there particular ticker symbols that you have in mind, or
certainly. My best advice would be go to my website under the menu and hit on the recommended investments link, and you'll see all those funds with ticker symbols. Yeah. I mean, there's a few, right? So the ticker symbols, the 5-letter ticker symbol for each mutual fund, it's easy to identify them when you know them. So also, if you go to Vanguard and you type in those funds into the search engine, the symbol will be right beside the fund. So the ticker symbol's right there beside the fund.
Or come to your meeting next Wednesday.
Exactly. And I'll have them. Yes, sir. That's right. And I'll go through some of that, like walking through a fund and seeing exactly what it owns and what it doesn't own and how it's done over time, so forth. Yeah, we have a little time. Sure. Bring up Vanguard.com. Actually, that's not for now because we're starting to run short. But certainly, if you go to Vanguard under the symbol, type in some of those funds, you'll see more, and then that class that I'm providing will give you more insight. VTSAX? Yeah. Correct. And investor shares have now gone away. So Vanguard has now eliminated investor shares. So it used to be you had to have $10,000 to get to Admiral shares. Now you only need $3,000. So again, that's the way Vanguard has been built by John Bogle. More money coming in, the cost of your investments go down. And so they've continued to come down over time. Yep. Any other questions? Yes, sir. That is correct, unless you put money in the settlement fund, which is a federal money market. There's no minimum, paying about 2.3. So generally the advice, put money in there. If you get to 3,000, then you buy into the prime money market. $250. The checks have to be for at least $250. Not so much. So Vanguard would prefer you to keep at least $1,000 in the account. But from my experience, they're not going to say much to you. They're going to, as long as you have $3,000 to open the account can actually drop below that amount over time. Yep. Yeah. Okay. So, backdoor Roth IRA. So the federal government says you make too much money. You're rich, so you can't put money in a Roth IRA. Well, yes, you can. So the way you do that is a couple steps. One, you got to get rid of all of your traditional IRAs. You don't, because it'll be a tax nightmare if you have traditional IRAs. So if you have traditional IRAs, try to stick that money inside a 401k, hopefully a good 401k. So get rid of all traditional IRAs, and then you put money in what's called a non-deductible IRA, traditional IRA. So you put money into it. Let's say you're 50 years old, so you can put away $7,000 this year. Put $7,000 into a non-deductible traditional IRA, and then a few days later, you convert that to a Roth IRA. So you send that money over to a Roth IRA, and now that went in the back door, and now your money's in a Roth IRA, and that's perfectly legal. So there's all kinds of ways as we gather education on how to get that money working for you most efficiently. Any other questions? So, yes, sir.
Why didn't we ever get to see the
It's a fair question. So, one, I'm always wearing it. It's on. Okay? So, because it is a metaphor. It's a metaphor for thinking and maybe even believing some crazy stuff, like you could actually take control of your life as well as your money. But I'm always wearing it. If you come to my kickoff event on August 27th, where I'll be giving away $1,000 at UNI, I'll be wearing it that night, literally. So do wear it. You could probably Google the Steele Report. I wore it on the Steele Report this year, Channel 7 News. So on occasion, I literally wear it. But what I would tell you is metaphorically, I'm always wearing it. And I want you to wear it too, by the way. Okay. So my story tonight is deemed October 2nd, 1989. Very specific date. It's one of those dates that can change a life. And it's a date that changed the course of my life. So for some of you, if you've read my books, you know a little bit of my story. I basically was investing my money, didn't know what I was doing. I read a book, and basically I came to realize I was doing everything wrong. Didn't know what I was doing. And so I started reading, and I started just consuming information. I didn't always consume the right information because I didn't have anybody telling me what the right versus the wrong was, but I was consuming. And gradually I started to find the right resources. And it gave me the courage on October 2nd, 1989, to go fire my financial advisor. You know, he was an old guy. He was like 40. I was a kid. I was 25. And I remember like it was yesterday. You know, I walk into his office, and I told him to sell the high-cost, loaded, managed mutual fund that he had put me in legally. And he tried to talk me out of it. You know, that's what they do. And I just cut him off. You know, I built, through the knowledge, I built the courage where I knew what I was doing. And I told him, do what I tell you. It's my money. I'll be back in a week. And I left and just shut that door. And I'll tell you what, whew, it gave me goosebumps when I did that. Now, granted, I was still broke in many respects, but there was like this moment in time where I could see how my life was heading in a very different direction. And, you know, I'll never forget that. And I like to share that story because it can apply to you. It really can. You can change your life at any moment in time when you're ready. And it does take knowledge and it does take action, but you can do that. Some kid from Iowa at the raw age of 25 did it, and so can you. And I'll leave you with that. Thank you, folks. Don't forget that questionnaire up here that Patty brought up if you'd like to review it and help yourself.